Hey traders and investors, it's Serge Berger here. I've been getting a lot of questions on Apple again lately, and that's not surprising, of course, because of the somewhat of the pop and drop type of price action we've seen in the past few weeks. So I think it's time to kind of revisit and explain a little bit what's happening here. More importantly, I think what's important to understand is that anytime you have a chart that or a stock or any asset that goes really steep, and I've mentioned this many times, and it's something I discuss with the study trader members all the time. You don't chase stocks or assets that go vertical higher. You don't chase them higher, right? It's just a low probability of making money. And it's a high stress rate of making money. So when I saw that Apple rallied very strongly off of those, I guess it was like was it mid-January? Yeah, let's call it mid-January lows. Stock rallied about 27, 25, 26, 27% over the course of about let's call it a month. That's a very steep rally, particularly for the largest company by market cap in the world. Okay, that's really that's a big move. So in the meantime, what the stock has done is mean revert down about 8%. Okay, and that's again to be expected. From a percentage perspective, this so far is about 38.2%, which happens to be a fairly important Fibonacci retracement level, but that's maybe a little bit more technical than we need to be getting here. But more importantly, what I want to get to is a very straightforward way of now measuring where's a better spot for Apple to sort of bounce and where could we potentially look at getting back in. And the obvious level here is around 120 bucks. Okay, and it's the obvious level. It may be too obvious, but here's the reason why it may actually kind of work. So for one, of course, you obviously have previous resistance may now become support is one of those technical analysis 101 things that we like to regurgitate, and it for the most part it is a very straightforward and basic way of looking at things. A lot of times though, what would happen is that because everyone knows this rule, that essentially this breakout area would have to be retested now, so we'd have to get a move back down to say 119, 120. A lot of times, because everyone knows that though, what the stock will actually end up doing is kind of make a bottom either above it or below it. So in other words, either we start bouncing here or we drop below here and then start rallying here. So from that point of view, it may not be the best area to look for the bounce. However, another thing I always say is the more things line up at one area or one moment in time, whether that's all technical or you throw in some news and structural stuff in, the better the support or resistance area becomes. So in this case, you have the rising 50-day moving average, which has been fairly useless as a moving average, by the way, over the past at least year to date. But you now have this yellow line starting to coincide with this lateral support area around 120. So from that point of view, if indeed we do see another push lower, this could become an area of interest where we could start loading up. So for those of you that played this stock on the short side, like I have over the past week and a half, it may be time to start taking a little bit of profits, because as I say, you never know when the stock starts bouncing. And that's why I always say that the first few percent of a swing, in this case a swing down, is the highest probability part of a swing. So if you need more clarification on that, you can hit me up on Twitter. My Twitter handle is SteadyTrader. Otherwise, head on over to thesteadytrader.com to see what we're doing over there and how we can teach you how to become a successful self-directed investor. Hope this makes sense, guys. Any questions, please let me know, and I'll see you in the next video.